Hello, good morning, everyone. Good afternoon, depending on where you're at. Thank you so much for joining. Give it a second, let everyone pop in here. All righty. Looks like we got, yep, seems like see everyone now. Hello, everyone. Welcome to the Mastering Financial Statements webinar with our guest, Joe Saari, the founder of Financial Fitness Group. If you do have any comments, feel free to use the chat box. But if you have any questions, feel free to use the Q&A button at the bottom of the Zoom window, and we will look to cover as many as we can at the end. From there, though, Joe Saari, I'd be happy to just pass you the mic.
Awesome, and welcome everyone, and thank you so much for joining. As Bobby said, my name is Joe. I am an entrepreneur like many of you. I know we've got a fairly good-sized group of people who've registered. Some of you are just getting settled and kicking in. My background is I grew up in Madison, Wisconsin. I've probably started or been involved in starting 4 to 5 companies, depending on how you look at it. From when I was young, I did painting companies while in college, 2 different ones, then went on to form a tech company, actually a couple, and most recently built, grew, and sold a company called the Financial Fitness Group. I work for Founders First for the last 5 years on a part-time basis, and I also work for the company we sold my company to. So the purpose of today's session is to talk about kind of mastering financial statements. I don't want to pretend you're going to master it in an hour session, but I want to get you comfortable with the reality is that you have everything you need to be confident to communicate about the finances related to your business. One of the weird things about our country is we really have taken capitalism to the next level, but your average high school student will have done 1,000 hours of gym class, 1,000 hours of study hall, and until recently hasn't had even 10 hours of formal training about money, right? So we have hundreds, if not thousands, of decisions to make in our adult life about credit, about banking, about financing a vehicle, buying a home, saving for retirement, let alone all the things that you all need to know to run and operate your business. But at least in our traditional K through 12 school, very little, if anything, is really covered to talk about the language of money. The good news is there's nothing about money or financial statements that requires more than basic math. Like we're talking 6th grade math to understand. Some of you may not love numbers, you may not love math, but I'm highly confident we all have enough skills to be able to truly understand a little bit more about financial terms and topics. So today we're going to talk about financial statements. And some of you might be into exercise, you might be into health. We've gotten more familiar with things like our credit score or our cholesterol level, different measures or metrics. Well, just like you may be familiar with those kind of KPIs of sorts for health, like your blood pressure or your pulse, the reality is your business has them too. And so in as much as you want to scale your company and consider the possibility of engaging a business partner, a banking relationship, credit, an investment, or sell the company, the reality is that you owe it to yourself and all the hard work you've done to get at least familiar with financial terms. You don't need to be an expert, but I want you to be comfortable enough that you know what questions to ask from the experts. So before I go much further, I did want to ask through the chat, if you can, tell me a little bit about your business, how many people you have, annual revenue. I just want to get a feel for who all is on the line. So if you can do that through the chat, that would be awesome. And see if I see the chat. Okay. So take just a second, tell me a little bit about, hey, my company has got 5 employees, 500,000 in revenue, or 1 employee and 50,000 in revenue. Or, I work for a company that does this. And I'm not seeing messages just yet. Bobby, are you seeing anything? I want to make sure that I'm asking people to go to the right place.
Not quite yet. It is open to everyone though, if they would like to. Oh, there we go. We got some comments.
Okay. And so we've got, is that 2.5 million maybe in revenue? So we've got a big company there with 110 employees in the janitorial space, 10 employees down to two. Yep. Okay, great. And so part of what I was guessing is we've got a pretty diverse range. Obviously, as somebody grows a business to 2.5 million, my guess is you've got some familiarity, or if you don't, you probably have a person on your team that's managing some of these things. We've got 1.3 million in receivables. Okay, so we've got some good sized companies. Excellent. My company, when we sold, was about 3.5 million in revenue. We did not have a chief financial officer. We did have an outsourced bookkeeper, and I guess controller to an extent, but a lot of the things that had to happen during the sale, which required a CFO, in my case, I started to step in and then realized pretty quick that I needed to hire a fractional CFO, because even though I have a finance background, it was more than I could tackle. So we've got a company with 25,000 in revenue. Well, and that's kind of one of the cool things. That's why I wanted to ask. So we've got about 20 of you on the line, and it sounds like probably we've got a variety from 1 to 2 person shops with just getting started, 25,000 or so in revenue, all the way up to several million. So I'm going to go ahead and talk a little bit about the financial statements, and we'll kind of dig in. I'm going to try my best to adapt the presentation to make sure it's relevant to all of you. Okay, so you should hopefully see my screen now. Bobby, if you can confirm you can see my screen okay?
Yep, we can see it great.
All right, so these are some courses that my company has published to help investors. So say, for instance, you're interested in investing in another business, understand how to read and then analyze financial statements. So one of the reasons that I want to share this content with you and kind of this perspective is chances are if you're here, maybe you're interested in improving the understanding of your financial statements just for operating your business that much better. But more often than not, it might be either for seeking capital, or if you're working towards the possibility of selling the business, having your books in good order is kind of critical. Just like if you want to sell your home, if you leave the home cluttered, uncleaned, and you leave certain maintenance items off, you're going to get a lower price. When it comes to building a business, whether it's investing or, selling it, the better order your financial statements are, the more likely you can A, secure financing, and B, execute a sale if so desired. And just running the business is that much better too. Imagine you're trying to drive your car, and your fuel gauge doesn't work and you can't, see the temperature. So three main kind of financial statements that all investors are going to have an interest in: balance sheet, income statement, and statement of cash flow. I'm going to start with the balance sheet, and I'm going to push through a quiz to you all, just to see if you all can take this. Nobody will see your responses, but I want to push through the quiz here. Give me a sec. And just let you take that quiz and kind of get a feel for how you're scoring on understanding a balance sheet. And as you guys are going ahead with that, I'm going to read a few more of the comments as well. And Bobby, please confirm you were able to see the link to the quiz and click on it and pull it up.
Yep, I can see the link and I clicked it. Yep, it brings me straight to the quiz.
Okay, and again, you're not entering any private information. This isn't going to be scored in terms of saved or associated with you. So just Honor System just wants you to go ahead and take that quiz and get a feel for how you do. The quiz that each of you get will be different. You're not going to get the exact same questions, but it should cover some of the key things that are covered in this tutorial. And I'm going to let you go just another minute or two. And as you finish it, shoot back your score. If you did great, awesome, want to see it. If you struggled, that's okay too. All right. And I'm going to go ahead and share my screen again as I get some of your responses in. So give me a sec. Okay, nobody's chatted back yet, but let me go ahead and share the screen just right away. And again, the purpose of that isn't really to put you on the spot. The reality is, if you're not familiar with some of the language in here, you're not alone. The first thing I want to cover is kind of what's the purpose of a balance sheet. And I'd love for those of you who can to go ahead and tell me what the purpose of a balance sheet is. But as we go forward, the reality is balance sheet is in some ways, a way to understand the snapshot of what you own and what you owe at any given time. So again, it's what you own, and what you owe. So if you have $100,000 in the bank, but you got $1 million in debt, that gives you an understanding of kind of your financial position. Why is it important to investors? The reality is, for a bank, they're interested in kind of liquidity, right? So do you have enough money that you could, if I lend you money, that if you had to, you could sell off assets like your home or a car to repay that loan, right? So a balance sheet is a snapshot of what you owe and what you own. And the basic concept of a balance sheet, as kind of explained in the tutorial, is that it's going to, surprise, surprise, balance, right? And one of the reasons for that is basically you've got total liabilities, shareholder equity, and total assets. Usually you would see this in the other form, where the assets is up top, what you own, and then what you owe and what's left over. So it's not uncommon, if you run an LLC and you've got a loss, that you might at some point have negative owner's equity, meaning at some point you may actually have negative owner's equity. Cool. We've got an AI assistant helping E. Davis take notes for the meeting. All righty. That's kind of cool. All right. So I'm going to move forward, but this particular tutorial, if you are interested in the topic and you're uncomfortable with some of the language, I want to encourage you to take the time to go through the course. The link that I shared, you can use and bookmark, but it will go over anything that you may not understand. Like if you don't understand, what is stock, or different things, you can mouse over it and get a plain English definition. One of the things I did want to take a minute to show you is kind of the example of a balance sheet. Sorry, it looks like in this particular link, I have to click through, and know that I have to click through each individual course to get to the next one. So let me go there. One thing I'd love to know from you all is how many of you are involved directly in doing your accounting, and or how many of you are leveraging a third party, right? And how often do you review your financial statements? So here's an example of a balance sheet: current assets, fixed assets, total assets, and the total assets here are going to always equal your liabilities and your shareholders' equity. So in this case, the liability is 40,000, and shareholder equity, meaning the value of the stock or the ownership, is a total of 48,000. And that is going to balance. I'm going to go back over to the analyzing a balance sheet. So for many of you, especially those of you who've got, $1 million in revenue or more, that might seem like fairly simple stuff. And that's okay. And if it's new to you, that's all right too. The reality is you're going to kind of, you're all going to get started where you are. The other tutorial course here that I want you to be familiar with is Introduction to Balance Sheet Analysis, right? And so if I'm an investor, what am I going to look at? I'm going to go through and take the quiz here real quick, just because I need to do it to get to the next topic. But I want to go through some of the ratios on a balance sheet, that are important to run a business. And this would be kind of the equivalent of looking at your gas mileage or your gas gauge, your RPMs, the things that you would see on your dashboard. So again, the reason that people will analyze balance sheets, if I'm a bank, there's literally thousands and thousands of companies I could lend money to. So looking at your balance sheet and comparing it to the other alternatives available to me is very, very helpful. You as an investor, if you want to invest in the stock market, you've got tens of thousands of companies you can pick from. And so, analyzing the balance sheet is something that some investors are going to spend time to do, or you rely on analysts who have done that for you. What I did want to touch base on were some of the ratios. So liquidity ratios are, I think, incredibly important when you're looking at debt financing. And so generally what you're looking at is your current assets, money that can be converted, so assets that can be converted into cash within less than 12 months, compared to those bills that you're going to have to pay within the 12 months. So there's a number of different tools, current ratio, asset test ratio, that investors use to get a feel for how likely it is that your company is going to be able to meet its obligations. Even if you're not looking for funding, however, kind of keeping an eye on your current assets versus current liability is really, really helpful. Many of you might know in personal finance, you're encouraged to have at least 3 months of expenses, personal expenses, in a cash or cash equivalent form, so that if you had a job loss, you could weather the storm, find a new source of income in that 3 months, and not end up, living on the streets per se. That's really what this current ratio concept is, do you have enough cash in the bank or cash equivalents, things that can be turned into cash within 12 months, such as inventory, that you can meet your obligations, the debt that you have to pay, your credit card bills, your loan, SBA loan, whatever it is. There's a couple other variants of that. So the asset test ratio, which is removing inventory, right? And Bobby, why do you think you'd want to remove inventory when you're looking at somebody's ability to meet kind of current obligations? And you might be on mute, Bobby.
I'm not too sure.
Well, if you think about it, say if I've got a coffee shop and I've got $50,000 of coffee in inventory, but maybe 2/3 of that is coffee that nobody's buying, right? So if I'm trying to pay my bill, yes, in theory, I could sell off the products that I have to get cash to pay my credit card or to pay my bank loan. But sometimes you get bad inventory. In other words, you purchase products or goods that just aren't selling. So that's the idea from a second level, looking at, okay, what's my ability to pay removing inventory, right? Because it's a little less liquid. There's more risk. Other topic we want to talk about is working capital. Any of you who get involved in selling the company, the idea of working capital is the amount of money that your business must have in order to operate, right? So imagine you open up a hot dog stand, right? In the days before Venmo and credit card, let's say you're only going to take cash. In order to operate that hot dog stand, chances are you need to have some $1 bills, some $5 bills, some $10 bills, and some $20 bills, because people are going to come up and need change, right? That's kind of that concept of working capital, right? And so working capital is really the current assets you have minus current liabilities. So if I've got $100,000 in cash and $20,000 in debt due over the next year, in that simple example, I've got $80,000 of working capital, right? That's kind of the amount of money that's going to stay flowing through my company so that I can meet other obligations like payroll, rent, etc. So these are all tools that when you go to sell a business, generally the buyer wants to see that you have some amount of working capital in the business when they acquire it. How about leverage? Anyone on the call invest in real estate? I imagine a few of you own your own home, maybe you own a business. And keep me posted on any questions or feedback we're getting, Bobby. But the idea of leverage is going to be your long-term debt over equity. A company that is more leveraged has the possibility to provide a better return to their owners, but it also comes with more risk. And probably the easiest way to understand that for most of us is if you think about buying a home. For those of us who were living through the 2009 kind of mortgage meltdown, remember back then people were able to buy homes with no money down, interest-only loans on properties. So in other words, they had complete leverage because they had no equity in their ownership in the home. As long as house prices were going up, that seemed like a really, really good deal. But when house prices started to level or come down, suddenly people had negative equity, meaning they owed far more on the home than their mortgage. So their long-term debt exceeded their equity. And what happened, right? Here in California, in some neighborhoods, 25% of people lost their home to foreclosure. Same thing is true on a business. Some of us will seek things like revenue-based financing, which is a form of debt that Founders First offers. But if you get too much, and the advantage of that debt is you can acquire capital to grow and run your business without diluting ownership. You don't have to bring on new equity owners. But at some point, if your long-term debt is too high, you can run into the risk where you've got too much leverage. And if you have a downturn in the market, it can be a challenge. Some of us were brought up to believe that debt is bad always, and some people might be debt adverse. I'd encourage you to kind of get your own relationship with it. The reality with most things, there's kind of somewhere in the middle. Debt can be a really useful instrument for the right type of investment. All right. I'm going to skip over the corporate bank sheet, but this particular course, so we've covered the balance sheet in pretty good detail. I wanted to now move on to talk a little bit about the income statement. And Bobby, I just want to double and triple check. You can hear me just fine?
Yeah, I can hear you just fine.
Okay. Give me 1 second. I'm going to stop sharing my screen just to see. Here. Okay. Got it. We got a few more people who've come in since we've got started. And I do believe that this is being recorded for those of you who might have come in a little bit later. So we've talked a little bit about the balance sheet, what you owe and what you own. Now let's talk a little bit about the income statement. Usually I find in having coached entrepreneurs and worked with them, most people have a little better understanding of the income statement or the P&L, profit and loss statement. Tends to come fairly natural. Balance sheet and cash flow statements tend to be a little bit hard. But if you're looking at the income statement from the perspective of an investor, so this particular course, should you dig into it, is going to look at it from the perspective of if you were to invest in a company. I'm not going to go ahead and have you do the quiz. I will shoot it to you in case you want to, but I'm not going to pause for it. So let me put that through the chat. And hold on 1 sec. For those of you who do want to kind of click along with me, I just put the quiz through and you can take the quiz if you care to. I'm going to just click randomly on my screen, so no laughing at how poorly I do. All right. And then in order to kind of walk you through the content, most people get a fairly good understanding of kind of the P&L. This is a relatively detailed P&L. So you've got sales or revenue, less cost of goods sold, which gives you your gross profit. And here we're comparing last year to this year. So, you can look at it on a ratio basis as well. So obviously here, the revenue went up 90,000. And then it looks like the gross profit went up 100 and I can't do the math, maybe 47,500, which is great. So they sold more, but they also ended up making a lot more profit. Less general operating expenses, same thing here. Less depreciation, we'll come back to that. Operating income went up sizably, other income, etc. So this is a way to get a feel for every dollar I sell, am I making money? In this case, they're doing pretty well, right? So net earnings of 470,000 on 900,000 revenue. I'm sure many of us would love to have that sort of business. 515 here. And then in this case, if the company is a corporation, you got less common or preferred dividends paid or taxes and your retained earning. So that gives you at least the kind of an idea of the income statement. In terms of things to touch on, so gross profit, from a lending perspective, revenue financing in particular, but other forms of lending in particular, generally looking for gross profit, perhaps 40% or more, optimally even higher, right? So if you have a software company like the one that I just sold, we were doing 3.3 million in revenue. And I think our gross profit was probably around 3.1 million, meaning we had a very low cost of goods sold because everything we were selling was provided to you in the format you see, hosted on the internet, right? So just the cost of serving up the product and then, providing customer support. So generally from a lending perspective, higher gross margins are going to make lending easier. From a value of a business perspective, generally higher gross margins are going to lead to a higher multiple. But not always, because it depends a little bit on other things in terms of your other costs as well. And so I'm going to go forward here. Operating income, right? So the idea of operating income, if we go back to our hot dog stand, right? My cost of goods sold is going to be the cost that I purchased the hot dog, in bulk from Costco, perhaps, and the buns. So maybe I'm selling the hot dog for $4, but each one cost me 40 cents, with the hot dog and the bun. That's my gross profit. My operating costs are going to include the labor for the person I pay to sit at the hot dog stand. If it's got electricity, or gas fired, those kind of costs to actually heat up the grill and run the cash register, et cetera. So gross profit, operating income is going to take out the operating expenses. And then ultimately, you'll get into earnings before interest and taxes. Oftentimes, it's going to be called earnings before interest, taxes, and depreciation. So people refer to it as EBITDA. In today's market, if you're looking for capital, either to sell your company or to finance a major finance from a venture capitalist or private equity, almost always they're looking at earnings before interest, taxes, depreciation, and amortization, or EBITDA. So here explained as earnings before interest and taxes, didn't take into account depreciation and amortization. I know we're not getting a ton of chat back and forth here, so I'm going to ask questions in a rhetorical way. But why do investors or why do a PE firm care about EBITDA? It's really pretty simple. I'm going to stop sharing my screen for a second so you can see me. If you think about it, when you're considering putting money in the bank, maybe you want to put it in a CD, a certificate of deposit, you're going to compare the rate that your local credit union provides to Wells Fargo to Ally Bank, right? So if I've got $10,000 that I want to put away for a year, and one bank is offering me 4% interest and the other is offering me 6% interest, where am I going to put it, right? I'm going to put it at the place that I get the best yield, assuming that I feel safe with that institution. The reality is, if you're looking at a private equity firm or a venture capitalist to invest in or purchase your business, at the end of the day, they're interested in that business's potential to provide a steady stream of profit back to the owner, right? So a financial owner isn't in business just because they love the mission of what you do. They may love the mission of what you do, but from a financial perspective, most buyers are ultimately going to come back to what is the potential earnings before interest, taxes, depreciation, and amortization, right? And the higher that number, more often than not, the higher the value of the business, or the more the business could command when raising equity or raising debt. I did get a question coming in, I think. Oh, no, just a comment from Fernando. Okay, thanks, Fernando. So I'm going to go back and share my screen. I think we'll go over to the analyzing this. Actually, I do want to go to the mnemonics because I think you might find that useful. Hold on one sec. I don't think I'm sharing my screen, am I? All right, I have to click through a few more to get to where I want to go. One of the reasons I do want to stop on the mnemonics thing is a lot of times financial people will speak in language that might intimidate us if we're not a finance person, but realize it's nothing more than basic vocabulary, right? So couple kind of interesting ways to look at it. Sonar or edit. So Sonar identifies the major sales and earnings. So sales, operating, net earnings, available earnings for common stock, and retained earnings, right? So one way to look at it, not super common to use. And edit would be less expenses, depreciation, interest, and taxes. So there we go. Let me get back here. And I want to look at, sorry. Nope. Okay, there we're gonna go that way. On analyzing the income statement, some things to look at. We talked about the profitability. I'm going to go through this as well quickly. And then again, you all have links to these tutorials or courses if you want to take them. I think you're going to find them helpful. And all right. So interest coverage ratio is one metric to understand the ability to cover interest payments, on debt, right? So the earnings before interest, tax, and depreciation versus your interest expense, right? And in other words, this is just trying to get a feel for, does this company have enough free cash flow to be able to pay the debt or the interest on the debt that they have? Got it. And somebody asked if they could get the links via email, and it sounds like we will get that over to you. And so happy to do that as well. In terms of profitability ratios, we talked about gross margin already, talked a little bit about the value to investors. But the idea in general is the higher the gross margin you have, the higher the possibility for profit, right? Hypothetically, you could change your operating costs. So why are investors getting so excited about AI, artificial intelligence, right? The idea is some of my operating costs, if I'm a content creator and AI can generate or make it quicker or more efficient for me to generate content, it might be easier for me to reduce my costs. So here in California, when you look at all the actors and actresses, trying to limit the ability to AI, to replace screenwriters or even actors for that matter, right? It's because the movie companies might want to reduce their operating expenses. I'm going to go ahead and net margin. So I think really just the difference between net profit and net sales, meaning, and I think we showed that earlier on the P&L, but let me go forward. I want to get to a few other items here. Okay. Depreciation. I think a fair number of you might be familiar with it. Is kind of weird concept, right? For tax purposes, depreciation can be very, very helpful, right? So one of the reasons why people might enjoy investing in real estate, over time, most homes might last 100 years, even 200 years. But according to the Internal Revenue Service, if I buy a home, it has an expected lifetime of 27 years. Meaning, if I buy that home for an investment, I can deduct 1/27th of the purchase price as a depreciation expense to reduce the amount of taxes I pay. If I own a rental car business like Hertz or Enterprise, and I buy a car, I believe a car has a couple different methods of depreciation, but in general, it can be anywhere between 3 to 7 years that it's appreciated, that value of the car, the $30,000 car, might have a lifetime of use of 3 to 7 years for tax purposes. So depreciation expense is something that generally investors are going to add back in when they're looking at your free cash flow or your EBITDA, because it's not real money, right? It's beneficial. You paid for the car when you bought it. You paid for the home when you bought it. But the tax deduction, is scheduled according to the IRS and their rules. There's a fair amount of information in this particular tutorial about different types of depreciation. There was a rule, I don't know how many of you were affected by this, but the Trump tax rule required that R&D expenses for software companies were depreciated over, I think, a 5.5-year period. So prior to that law, most companies like mine, where we were spending $800,000-900,000 a year on software development, would expense the entirety of that amount in 1 year. And the Trump law basically said, no, you can't do that anymore. You have to take that 900,000 and take 1/5 of it, for oversimplification, meaning our company in that case generated an additional $700,000 in profit for tax purposes, right? So depreciation is kind of this weird thing, but it is always taken into consideration by investors trying to understand the value of your company. I'm not going to go into this in detail. The last one I do want to talk about, though, is the statement of cash flow. Many of you have taken a Founders First course. Many of you have heard Kim Phillipson speak. If you haven't, one of the things that you're going to kind of think is that cash flow is kind of like the blood of a company, right? The heart, is the operations that's pumping the blood through our veins and making our muscles and brains and bodies work, but the blood itself, the cash, is required to make a business run, right? So if you become dehydrated, you don't have enough blood, et cetera, your business won't go well. So a statement of cash flow is looking at really cash that comes into the business and cash that comes out of the business, and understanding one's capacity, to pay the bills. So let alone whether it's profitable or not on an accounting basis, do you actually have the ability to pay the bills as they come due? And so why does it matter? Firms with poor cash flow may have difficulty making interest payments, loan payments, or dividend payments. In other words, they may have trouble paying their bills. So this is something that generally investors take a very, very careful look at. And when you're running your company, especially if you're tight on cash, many of you probably have some sort of tool, or if you don't, you'll want to chat with your bookkeepers about it, on how you're going to manage your statement of cash flow. QuickBooks as an accounting tool does a really poor job creating a statement of cash flow. So most bookkeepers or accountants, who are helping you run your business might create their own statement of cash flow because for whatever reason, QuickBooks has never really taken the time to build a good one. In terms of statement of cash flow, just what it looks like. So cash flow from operating activities here, cash flow from investing activities, and cash flow from financing activities. So kind of sources and uses of cash. All right, so income, if this is on a cash basis, the revenue that comes in is flowing into the company, adjusting it for any kind of non-cash related items, taking out things like account receivable, inventories, and accounts payable, gets you next cash provided by operations. So in this case, you've got $635,000 of cash by operations. From investing activity, in this case, this particular business has purchased a fair amount of land, equipment, or other businesses, and disposed of cash in other ways. So it spent money to invest in other assets. So 635,000 came in, or million came in, 415,000 went out. And then financing activity. In this case, they started with 210,000 of long-term debt, paid off 200,000, issued some common stock, etc. So you can see the difference of a statement of cash flow. Probably for most of you, your statement of cash flow is going to be a lot simpler, but it is something that is important and useful. I'm going to go over to the analyzing, and then we'll wrap up and see if you have any questions or comments. Bobby, you can still hear me just fine, right?
Yeah, I can hear you great.
Okay. So again, I'm going to skip over the quiz here just to get us into the content itself. All right. So why investors analyze a statement of cash flow? Really, it helps an investor understand, one, the capacity of the company to operate. In other words, if it's got positive cash flow, that's a very attractive thing to operate because it doesn't require ongoing investments, to make it work. If you were to develop a drug, and you have to go through a 7-year period of getting FDA approval, chances are most of your cash isn't coming from operating activities if that's the only thing your company does, right? So in that case, all of your cash is coming from investors. And the cash flow helps you understand how long can you continue to operate, spending the money that you need to expend to try to get that drug approved. At what point might you run out of money? So, cash flow itself is kind of that blood running through the veins of your company to get a feel for, does it have the capacity to make it? From an investment standpoint, if your company has positive cash flow, that becomes highly attractive. So we have a partner company that does about 1.3 million in revenue. We do 3.4 million. Our free cash flow was probably at best around $600,000 to $800,000. That particular company with 1.3 million had 800,000 in free cash flow. So the reality is, to some investors, the businesses are worth the same thing. We have 3 times the sale, but they have an equal amount of cash flow, right? Which is really the resource, like a dividend or an interest rate, that investors are looking for. Last few things here. A statement of cash flow reveals a company's financial flexibility, right? So the greater cash flow you have, and you often hear this about a company like Google, who literally has been printing money for decades, they have a fair amount of flexibility to try new things, right? Because they have billions and billions and billions of dollars in the bank, right? Their ability to meet payroll, even though it's a huge payroll, is fairly simple for a company of that size. So they're willing to make major bets and try on things, some of which work and some of which don't, Tesla is now at that point. For years, though, Tesla was dependent on financing, right, to get to where they wanted to go. All righty. Using the cash flow statement to analyze troubled companies. I think one of the things, some of you have probably been at a point where maybe you had to do factoring, right? Where you're selling your invoices early for a discount. And in some ways, that's a company that's typically factoring is doing so because they either haven't taken the time to present their financials to get a cheaper form of financing, or perhaps they're not yet profitable enough or generate enough cash flow to get traditional financing. Okay, so we're about 47 minutes in. I know that we've got a fair number of you on the call. From a Q&A perspective or question, I want to see if anyone had any questions for me. And Bobby, if you want to go over any of the questions that we got in advance of the call, I'm happy to cover those as well.
Yeah. While we wait for some people to add in some questions, I do have one. One question that came in was, do you suggest using a platform such as QuickBooks versus a spreadsheet when finances are tight? Is it worth actually spending the extra money?
Depends a little bit on the size of your business. In general, yes. Assuming you're, 50,000, 100,000 or more in revenue. The challenge with QuickBooks, right, isn't just the cost of paying for QuickBooks Online, but it's the cost of doing the bookkeeping. But assuming we're talking about a company, 50, 100,000 revenue or more, I think it's well worth it to outsource bookkeeping and pay for the QuickBooks. You shouldn't hopefully be talking about more than a few $1,000s a year. Excel might be viable for a small company just getting started. But certainly if you want to grow and scale the company, you're going to need some sort of accounting system of record, whether that be QuickBooks or something else.
Awesome. And then I haven't seen any other questions. We do have one more. If everyone has any questions, feel free to add it in the Q&A box, but we can cover this last one. And then if no more pop in, we can close out the webinar. But the last one is, we are interested in retirement plans for our employees. Do you have any tips to financially prepare for this?
Yeah. So it'd be nice to know, first of all, if the company is using a PEO. PEO would be a company like TriNet or HR Sidecar, that is bundling benefits for you. Or if you're doing your own payroll, through something like Sure Payroll or QuickBooks Payroll. I'll answer it for both scenarios. So if you're doing your own payroll, meaning maybe you're processing payroll, using Sure Payroll or QuickBooks Payroll to do the withholding taxes, but you're shopping for your benefits, your cost of the 401k plan typically is going to be a combination of the time it takes to shop for and find the plan that is best for your business. But then often, trying to make sure that you're going to be compliant, right? And so depending on how many people you have in our company, in order to be compliant, we had made some decisions that we were going to provide a 3% contribution to everyone on their 401k, right? And so that we treated equally to executives, making 150, 200,000, as well as to rank and file employees at 40, 50,000. So the cost for us of a 401k was substantive with 20 employees. It was probably $60,000, $100,000 a year of contributions we chose to make. But you can get started on a much lesser level. If you're going to shop for yourself, just be thoughtful about who you're relying on for guidance. If you have a PEO, TriNet or HR Sidecar or something, ADP, generally you're going to find they're going to walk you through the various options for compliance. And sometimes you can offer 401ks if you don't have a huge pay disparity significantly cheaper than what it cost us. I hope that answers the question. But it's certainly from a, if I know many friends or colleagues who have businesses, maybe a 7, 8 person company, engineer consulting company, where people are making pretty good money and they want to maximize their pre-tax contributions. It's worth it for them to offer the 401k plan, one for the benefit of the owners, kind of the partners in the business, but also it helps retain, the people just getting started. But you do have to have, if you want to generally be complying with kind of safe harbor rules. So you oftentimes need to help contribute to for the people who are making less money so they can fully participate.
Awesome. And we had another question pop in too. Let's see if we have time for both of them. But the first one being, would quarterly membership fees yield profit, or would it be best to have additional revenue streams?
Yeah, it's an interesting aspect. We have a client who does quite well in the investment management business, in which they bill their clients quarterly. And they are certainly quite profitable, but they do need to run their business in such a way that they're leveling the expenses, right? Because their fees of what they get come up and down. I certainly think to some degree, if you can layer in some sort of regular monthly or even transactional revenue, Destiny, it might be easier to manage the business. If you're doing just quarterly membership, my guess is you probably want to retain a little more cash in your savings account so you could get through any bumps along the way. I hope that makes sense. I think I see you have a second part of the question, but real quick on the first part is some of you probably maybe have been or know people in the real estate industry, be it brokers or mortgage brokers. And same sort of thing, like when your revenue is a little less predictable, oftentimes it's important to have a little more cash reserve.
Awesome. And then that last question, looks like we have some time, is I'm still in the building phase of my company as a recent college graduate. At what point should you pay yourself and your employees?
It's an interesting question. So Destiny, if I ever write a book, it's going to be 101 Reasons You're Smarter Than Me. If I can do it, you can do it too. So I ran my business for about the one that I just sold for about 20 years. And I think I probably spent the first 10 paying myself last. Right. And for me, it was okay. I managed my finances and kept my expenses low. That it never created a tremendous amount of stress. But when I started a family and had children and financial needs, that wasn't always the easiest thing for our family. I will say that at some point I decided that I was going to pay myself first and bring on people later. And I paid myself, a wage which was good enough to live off of and allow me to save and invest a little bit of capital. I will say that in my own instance, that when I started paying myself first, the business started to do better. I think in some part because maybe I was removing stress and strain from my personal life. I think in other cases too is us as entrepreneurs often want to grow, we want to invest, we want to make things happen. We tend to be confident and optimistic. Sometimes we tend to be overly optimistic. And so I think if you pay yourself first and you live within your means, it does push how you get things done, maybe without always solving with money. Like, so for instance, I sold the company recently and I have some financial goals that I want to hit, but I no longer have the ability to just go out and hire people. So I was fortunate that I was able to recruit some MBA interns who were, one in particular was from India, who needed and wanted work experience, but didn't want to make money because he didn't want to use up his OPT. So in that instance, I paid myself first and I was able to find a way to get some of the work done in a meaningful way. So I guess I would encourage you, Destiny, to at least consider paying yourself something. Um, you also have to consider, if you're not paying yourself, are you living off savings, or are you going to have a second job, to pay your way? Got a question over there.
Yeah.
Okay. There's a question about VTO plan. Sorry. That I'm not following, Destiny, but thanks.
Cool. Well, I think that is the final question. Oh, vision plan.
Oh, I wonder if, are you talking about kind of vision plan for the business, or vision plan like as an employee benefit? I assume for the business. For me, at least we'll assume it's in the business, and I think everyone's going to be different in this. I've been passionate about the company that I created and the purpose of what it was, which was to create interactive educational experiences to enrich lives. In what we do, creating content and licensing it, that part of it was pretty clear and concrete. What's funny is when you look at a business in hindsight, it looked like a pretty straight line of revenue and profit. It definitely didn't feel like it. So, and it definitely took a little longer to get to where we wanted to go. Oh, got it. Yeah, I will say, I guess my own personal preference is for entrepreneurs, when you can pay yourself a reasonable wage, do. And necessity is the mother of invention. So if you're taking care of yourself to the point where and if you've got a significant other, you're not at a huge amount of stress, it does generally free up time to be thinking at a higher level. And the quality of thought, I think, for people is really, really important. You're going to make more money, not based on how hard you work. You're going to make more money based on how smart you work. The book I mentioned was a joke. Actually, it was, if I ever write a book, it would be 101 Reasons You're Smarter Than Me. If I can do it, you'll do it too. I haven't written it yet, though. But I tell you, if I do write it, I will. But the point on that, though, is, and maybe this is maybe what would be more useful to Destiny and others, is one of the best pieces of advice I've got in building a business is learn to fail faster. Right? I'm going to say that again. Learn to fail faster. Right? The person I got that advice from is a gentleman, you can Google him. His name is Chad Hymas. He's a professional speaker who, at the age of 26, was paralyzed from the neck down. He's got modest movement of some of his fingers and arms, but he's been in a wheelchair, for 25 years, speaking professionally. And him to get to that point where he could travel and go on his own required him to relearn thousands of things that we take for granted, like breathing or brushing your teeth, right? And his father told him, when he was sitting in the hospital feeling bad for himself, he said, "Son, you got to learn to fail faster." And I think we in our society are brought up to think that we need to get everything right, right? You get points in school for getting the test questions right. In business, you've got to be willing to try and take an honest assessment without feeling bad about it, that, hey, I tried that, it didn't work, let me try something else. So I think that ability to fail faster is probably one of the better pieces of advice I can give to young people or people in general, is, not be afraid of making mistakes, but also not be too stubborn to realize, yeah, I tried that, it's not working, let me try this now. So the quicker you can do that, the quicker you can learn. All righty. Well, I know we're at time.
Yeah, no, thank you so much, Joe, for your time, and thank you everyone for joining. We can go ahead and close that out, but we will be sending out this recording in an email. It will be most likely at the end of the day, but just expect that in your inbox.
Awesome. Thank you, everyone. Have a wonderful day and appreciate you.
Have a good one. Thank you, Joe.
All right. Thanks.